Good morning, good afternoon, good evening, wherever you are in the world. I'm your speaker for the topic Principles of Transfer Pricing. I'm Elsa Cañete. The transfer pricing is the most important topic today, especially in the arena of international taxation. The principles adopted by transfer pricing is the arm's length principle. Why? Because the arm's length principle is the accepted guiding principle in establishing an acceptable transfer price, which is provided under Article 9 of the United Nations Model Tax Convention. The arm's length principle also considers the transactions within the group, compare it to the transactions between the unrelated entities under comparable circumstances to determine acceptable transfer prices. When we say transactions, we mean commercial and financial transactions. The purpose of comparing the transactions between related entities and unrelated entities is because related party transactions has the element of control. Why? Because it is owned only by the same persons with same interest. So the independent entities is the benchmark for verifying the transfer prices, especially for intra-entity or intra-group transactions under acceptability for taxation purposes. Why? Because the marketplace is the true determinant or the true price exists. Why? Because the entities in the market are independent with each other. And when there is independence, there is no element of control. And when there is no element of control, the true price of the goods or services are affected. Okay, so what are the rationale of the arm's length principle, or why is it that the arm's length principle has been adopted by the advocates of the transfer pricing? Because in the arm's length principle, the rationale is that the market governs most of the transactions in an economy. Because in the true market, there is an adoption of the law on economics, which is the law on supplies and demand. And it is appropriate to treat intragroup transactions as equivalent to those between entities. That's why in the arm's length principle, we are going to compare the independent transactions as against the related party transactions. And the effect or the result that we want to obtain is that they must be similar or equal. Why? Because if they are not equal or similar, then the next step is to adjust to make them similar. Why? Because if they are not similar, then there would be a findings that the other transactions is not the true transaction. So we want to know what is the correct transactions. Once knowing the correct transactions, we have to correct the related party transactions to conform with the correct transactions for purposes of imposing the tax due or for purposes of paying the right kind of tax. Intragroup transactions are tested and may be adjusted if the transfer price are found to deviate from the comparable arm's length transactions. That's why we have to adjust. And when we say adjustment, there is already a findings that there are some deviation from the independent party transactions and the related party transactions in their intragroup dealings. The arm's length principle is argued to be acceptable to everyone concerned, as it chooses the marketplace as the norm. The arm's length principle is also geographically neutral, as it treats profits from investment in a similar manner. So why it is geographically neutral? Because whatever is the source of income, they are treated similarly by the tax authority. The legal basis of the arm's length principle is Article 9 of the Associated Enterprises of the OECD Model Tax Convention. And what does this Article 9 said or provides? Where an enterprise of a contracting state participates directly or indirectly in the management, control, or capital of an enterprise of the other contracting state, or the same persons participate directly or indirectly in the management, control, or capital of an enterprise of a contracting state and an enterprise of the other contracting state, then what happens? In either case or conditions are made or imposed between the two enterprises, their commercial or financial relations, which differ from those which would be made between independent enterprises, then any profits which would, but for those conditions, have accrued to one of the enterprises, but by reason of those conditions have not so accrued, may be included in the profits of that enterprise and taxed accordingly. This is a very powerful statement of the Model Tax Convention. Why? Because if there are two or more enterprises and their commercial or financial relations differ from those between independent enterprises, then the tax authorities has the power to adjust. By adjustment, we mean the profits which has not been included in the enterprise where it is supposed to pay its taxes, then the tax authority of that state may adjust the profit declared for tax purposes by the enterprise by including the profits that has not been taxed and subject it to tax for purposes of collection or for payment in the tax authority. Where a contracting state includes in the profit of an enterprise of that state and taxes accordingly profits of which an enterprise of the other contracting state has been charged to tax in that other state, and the profits so included are profits which would have accrued to the enterprise of the first mentioned state if the conditions made between the two enterprises had been those which should have been made between independent enterprises, then that other state shall make an appropriate adjustment to the amount of the tax charged therein on those profits. In determining such adjustment, due regard shall be had to the other provisions of this convention, and the competent authorities of the contracting states shall, if necessary, consult each other. My experience would always tell me that in making an audit, one party have already paid the tax due on that same profit. So the contention or the allegations of my taxpayer previously audited told me that the profits have already been paid in the other state. So if you adjust the profit of the company in another state and tax it for purposes of collecting the tax that should be paid, then you are, or the tax authority is imposing or making double taxation by collecting income taxes on the income which have been already subjected to income tax. The internationally accepted principle of transfer pricing is that the arm's length principle, which is comparing the independent transactions with the related party transactions. The result should be similar or equal. If not, it should be adjusted by including the profit that has not been reported in the other state. it will result to double taxation. But double taxation is not per se prohibited. Sometimes there is double taxation. It cannot be avoided that sometimes there is double taxation, especially if it is willful in the part of the taxpayer not to pay its tax in the state where the profit belongs, and the collection of taxes should be paid in that state. Understanding related party transactions is very important in the study of transfer pricing, because if there is no related party transactions, then we have nothing to talk about transfer pricing. So a clear understanding about a related party is important in studying transfer pricing. And when we say related party transactions, that is the norm, or that is the principle that we have to follow in order that we can say that the pricing between related party is acceptable. The arm's length principle, which is the principle followed by transfer pricing analysis, requires that the transactions of related party be comparable or similar to the transactions of unrelated party. Why? Because if they are not similar, then it is a must that during the transfer pricing audit, the tax authority will adjust your profit, and the profit that has not been taxed should be included and taxed accordingly. Meaning there would be deficiency taxes, there would be additional taxes that should be paid by the taxpayer in a particular country. Understanding related party transactions. So how do we understand the related party transactions, or when there is a related party transactions? Okay. So the knowledge on how the parties are related is necessary to understand the rationale or background of relationships that will help in making comparability analysis. So in making comparability analysis, meaning we have to compare related party and the unrelated parties, or the related party transactions and the independent transactions. So it is necessary that we have to understand how the parties are related, because somehow along the way that relationship is the anchor of control, or the reason why they violated the arm's length principle. So in studying the arm's length principle, we have to know the true substance of related party dealings in order to understand and help in discovering the relevant transfer pricing issues. When we say transfer pricing issues, we mean there are gray areas that should be. The true substance of related party dealings can only be discovered upon thorough investigations. Sometimes they are so sophisticated that the true substance cannot be discovered, and therefore in some cases it is used to cover unpayment of taxes. In my study of related party transactions, I have to go through some research in order that I will be enlightened on what are these related party transactions. And some pronouncement in the international accounting standards help me understand what are related party transactions. Under International Accounting Standards, which is adopted by the Philippine Accounting Standards 24, it provides that a party is related to an entity if directly or indirectly through one or more intermediaries the party is controlled by or is under common control with the entity. These include parents, subsidiaries, and fellow subsidiaries. So there is an element of control, and control is exercised by one of the parties in the related parties relationship. Also, there is a related party if one or more intermediaries, the party has an interest in the entity that gives it significant influence over the entity, or have joint control over the entity. So depending on the structure of the company, the element of control, if found to be present, then there is a transfer pricing issue in order to determine that that related party transaction conforms with the arm's length principle. Also, there is a related party transaction if the party is an associate as defined in IAS 28, investment in the associates of the entity. This is still the international accounting standards as adopted also by the Philippine accounting standards. Or the party is a joint venture in which the entity is a venturer. So it is IAS 31, interest in joint ventures. The party is a member of the K management personnel of the entity or its parent. If the member of the K management personnel of the entity or its parent can be still considered related party when it comes to the company as a whole. Related party transactions can also be determined if the party is a close member of the family of any individual referred to in A or D. When A or D are the close family member of the family of the K management personnel. Also, the party is an entity that is controlled, jointly controlled, or significantly influenced by, or for which significant voting power in such entity resides, with directly or indirectly to any individual. When we say referred to in D or E, they are those K management personnel or joint venturer. Also, the party is a post-employment benefit plan for the benefit of employees of the entity or any entity that is a related party of the entity. In the Philippines, the employers are required to have a trust fund for the benefits of its employees, and this trust fund of the employees' benefits as set up by the employer should be registered or treated as a separate entity. But for purposes of determining a related party transactions, then this employment benefit plan established by the employer as to its relationship with the company itself, they are considered as related. Okay. In determining what is related party transactions, the Revenue Regulations to the 2013, which is the transfer pricing guidelines in the Philippines, which was crafted or which took effect on January of 2013, it does not define related party. What it defines is the associated enterprises. So according to these regulations, Revenue Regulations 2-2013, the two enterprises are associated if one participates directly or indirectly in the management, control, or capital of the other, or if the same persons participate directly or indirectly in the management, control, or capital of the enterprises. These are also referred to as related parties. So even if the transfer pricing guidelines of the Philippines, Revenue Regulation 2-2013, does not define related party, but the definition on who are associated enterprises is also the same as they are referred to as related parties. Meaning of control. So what do we mean by control? Why? Because the essence why we study related party transactions, because we want to know, we want to define, we want to discover if there is an element of control. Why? Because in the element of control, there is no correct pricing of transactions in the commercial and financial dealings. Why? Because what is this called control between the two related enterprises that makes it not acceptable in the pricing of goods and services between related parties. International Accounting Standards or Philippine Accounting Standards 24 define control as the power to govern the financial and operating policies of an entity so as to obtain benefits for its activities. This is very crucial. Why? Because the purpose in controlling one entity by the other entity is to obtain benefits for its activities. And what are these benefits? One of the benefits that can be identified is the lowering or the savings that it will make in the payment of taxes. Why? Because in some cases, in some countries, the payment for taxes is huge. It's very it can drain the company with its assets. So that's why companies are trying to avoid the payment of taxes in order that they can preserve their assets. Trying to discover or knowing what's the meaning of control, Revenue Regulations 2013, the Transfer Pricing Guidelines, define control as referring to any kind of control, direct or indirect, whether or not legally enforceable, and however exercisable or exercised. Moreover, control shall be deemed present if income or deductions have been arbitrarily shifted between two or more enterprises. It further defines control transaction as any transaction between two or more associated enterprises. So this Revenue Regulations 2013, the definition of control is very, is all encompassing. Why? Because it refers to any kind of control. So when we say any kind of control, any gesture, manifestations that there is an element of control, then that is already a distortion of the independence of determining the relationship between the parties. Another is direct or indirect. So any kind of control, whether it is directly enforceable, whether it is directly manifested, or it is really exercised, or it is indirectly, as if it designated another party to make that control. Still, that is tantamount to control as referred to in these regulations. Also, whether it is not legally enforceable, meaning there is no contrast, but it is manifested in the gestures, or it is being observed in the dealings between the related parties. Even if it is not exercised, or still it is exercisable, if there are manifestations that this control has been imposed between two related parties, then there can be transfer pricing issues that would crop up later on. Control also shall be deemed present if income or deductions have been arbitrarily shifted. When we say arbitrarily, meaning it is purposely done, and there is a reason for that, and we will try to visit again the International Accounting Standards and Philippine Accounting Standards 24. What is the reason why there is control? In order to obtain benefits. And who will be benefited? Of course, the group. Why? Because in the related party transactions, they are considered as the same group. So no matter where the benefits lies in a state, still the group is benefited. Why? Because the other party that has been in control is a member of the group. And if the member of that group in some country will not get its share in the profit of the enterprise, it doesn't matter. Why? Because it still goes to the group, and that group is benefited. So that this arm's length principle purposely is adopted in order that the tax authorities where the state where the company member of the group is doing business can also get its fair share in taxation. Why? Because if all the profits are shifted into another company in another place, then the place of production, the place of business of the enterprise or the state where it is located is deprived of its taxes to support the government. So control also defines control transaction as any transaction between two or more associated enterprises. So meaning it is any transaction between two or more associated enterprises, because if they are associated, meaning somebody or the key management personnel are the ones, the same person who are controlling them. So they are having a relationship when it comes to management. In defining control, I also refer to the IBFD, or the International Bureau of Fiscal Documentation, which is the authoritative body or non-profit corporations who provided also international tax services to both taxpayer and the government. So IBFD define control as a relationship, but it is typically in a corporate context. In a relationship, meaning there is a link between the parties. So this relationship indicates a certain degree of common interest. For instance, by way of shareholdings between the controlled and the controlling party. So when we say common interest, we mean, for example, there is a parent and a subsidiary. The parent is the owner of the shares of stocks. The parent is the investor of the subsidiary. So naturally, the parent can control the policies, the pricing of goods and services of the subsidiary, because it is given the authority to control because of its interest, especially since the parent company is the investor of the subsidiary company. Also in the context of transfer pricing, and also in legislation, domestic legislation of some countries which has a law on controlled foreign company, the context of relieving measures such as group treatment, control vary from country to country and according to particular measure. In some countries, 50% or more shareholdings considered to amount to control. Of course, why? Because if you have a 50% shareholding or ownership in the company, you have to control that company in order to preserve, in order to protect your investment. And also there is a distinction often being made in favor of voting rather than nominal share capital. When we say nominal share capital, there is no so much rights to vote. But in some structure of the company or the corporate structure, the voting rights, especially if you are the investor, is very important. Why? Because the voting rights give the investor, give the parent company the right to control, the right to participate in managing, and the right to make policies over the subsidiaries. What is the purpose of control? When we try to go back with the International Accounting Standards 24 to gain benefits, and who earns that benefits? in the analysis of the relationship between the investor and the investee, or the controlling company, and the controlled company, it is always the one who has the undue influence or the influence to the other party who is gaining or who has the benefits. How can this be discovered? How will you know that there is element of control? The element of control can be manifested from the dealings of the associated enterprises. Even if there is no contract or there is no agreement, but sometimes the dealings between the enterprises manifest that there is an element of control. The parent and subsidiary, especially in the pricing of goods or services transferred between subsidiaries, as it is the very essential part of control. Why? Because the pricing of goods and services comprise the activities of this company, and as an economic entity, the purpose of doing business is for profit, and this pricing of goods and services influence how these companies make and report their profits, especially in the parlance of tax evasion or avoiding payment of taxes. Why? Because if you have the control, then you can always price your goods in higher or lower depending on the benefits that you will receive in the country where the rate of taxes varies. Also, control is manifested through the power to govern financial and operating policies of an entity. As of today, 2020, transfer pricing cases already abound in many courts all over the world. And the element of control has been proved by the tax authority that are manifested not only directly but more so in the power to govern the financial and operating policies of an entity. So jurisprudence or court decisions will tell us that the tax authority, once they have proved that there is control in the operating policies of an entity, then there are transfer pricing issues that will result in the adjustment of profits and in the payment of taxes. Economic substance of related party transactions is very important in the study of transfer pricing. Why? Because it also in some cases, absence of economic substance in between related party transactions can be considered as sham transactions, and for purposes of computing the tax due, this economic substance, once absent, if the economic substance is not present in the transactions, then that can be disallowed, and any result of the disallowance that will result in the payment of additional taxes, then the tax authority will impose collection of additional taxes or resulting from the disallowance of this absence of economic substance in related party transactions. Going back to economics, economics deals with the law of supply and demand. The law of supply and demand is a natural law. Nobody can break it because it is a natural law. So knowledge of the working of the supply and demand and how they affect price and output in a competitive market is essential in the study of transfer pricing. Why? Because the economic condition is one of the comparability factors once we compare the related party transactions and the independent transactions, and our aim in comparing is to know the real transactions in order that we can impose the proper dealings and the proper adjustment and collect the proper amount of taxes if the result of that analysis is that the party in the transactions are not observing the real or the norms in the market. The supply and demand affects the price of the product. That is economics. So, once the supply is high and the demand is low, expect lowering of prices. But if the demand is high and the supply is low, there is a tendency that the price will increase. So that's how the law of supply and demand affects the market and the price of the product. If along the way the opposite happens, then it is no longer the norms of the market, but it is already the result of the control between the parties playing the market or between those market players. There is already an artificial price management, and that is not the real price of the goods and services in the market. Economic condition is analyzed how it influenced the price of the product and is an important comparability factor. Why? Because economic condition is very important. It influences the price of the product. It affects the price of the product. If there are adverse economic conditions, expect distortion of the price of the product in the market. Why? Because turbulence or calamities will tell us that the price of the product are affected, especially if the supply and the demand are affected. So solid understanding of price movement is important to all market players. That's why our market players are investing so much in order to make future plans and anticipate economic conditions in doing their business. They understand the price movement, meaning they have some data, they are compiling some data, and then make a decision out of that, especially the movement of the prices. Because the price or the movement of the price of goods and services in the market will determine the profitability of these market players. If they are not playing well in the market, then sometimes it will cost their business. It will be, the result would be they are out of business. That's why understanding of price movement is very, very important, that some companies are investing so much in order to predict these prices of the market. So how do we know, and what is economic substance? Because we are looking towards economic substance in order that we determine the true price in the market. So economic substance refers to the price of goods or services involved in the transactions between associated and independent enterprises, which are influenced by the market forces and not by the controlling entity through artificial price management. So there is only economic substance if there is no element of control. There is only economic substance if the law of the supply and demand is properly applied in the transactions. So there can be no economic substance if the element of control influence so much the pricing of the product through artificial price management. And when we say artificial price management, it is not the true price of the goods and services. So artificial price management, going back to the purpose of control, going back to the purpose why there is a distortion of pricing of goods and services, is the obtaining or achievement of benefits from the controlling party or by the controlling party to the controlled company.